Good morning. Can you all hear me? Make sure we're on. We got the right microphone. Get this video going. How's everybody doing? Hello, Brenda. You can see my trading partner's up there chilling out on the router. Morning, Kevin. I just realized I forgot to turn my phone down, the volume on it. Mute that other machine too. It's going to be dinging. All right. Awesome. Thank you. Hey, Jennifer. What's up, Helen? Hope everybody's doing good. I didn't get things sorted out, straightened out. How you liking this market? If you're a bull, you're probably not very happy. If you're on the dark side with me on the bear side, you're probably loving it, right? It is. I think it's about to get crazier, Brenda. It is crazy. But it's a craze that I like, actually. It's one of those things that, because I mean, most of you know, if any of you that follow me or have Patterns of Flash or Weekly Whispers, any one of you know that I've been bearish for 2.5 years. So it should be nothing new. So if we're meeting for the first time, welcome. Welcome to the bear market. I don't know what we name it. Bear market. I don't know what to name it. I'm not that creative. Got me a fresh cup of coffee, though. Let's get the disclaimer out of the way. I'm not a registered broker-dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading. So here's all the events coming up. Trading You Live, that is tomorrow and the 23rd. I don't think I have that on my calendar. I better double check and make sure. At 8 p.m. So Inner Circle is October 23rd and October 30th. Mastermind, October 24th and 31st. Trading You is 26th and November 2nd. Inner Circle Quarterly, October 27th and 28th. And then Power Option Plays Tuesday and Saturday. Of course, Covered Call Explore on Thursday. Power Hour every Monday. These are all the free online workshops, right? Power Hour Monday at noon. Trading Coaches Playbook every Friday. This one. And then Trade Like a Pro, October 25th and 26th. And then E-Mini Think Tank with Brandon and Vegas Spread Mastery with Sean at those times. Of course, you can follow us on all the social media platforms. And then if you like what I do, if you like my style of trading, then you've got Patterns of Flash, right? Which is basically all about patterns. Not only training your eyes to recognize them, but also what to do with them, how to trade them. It'll give you a baseline. If you're new to technical analysis, it'll give you the baseline you need. If you're not new to technical analysis, it'll give you the baseline you need. I'm shocked at how many times people that have been trading for 4 or 5 years, they come in and they've already been doing technical analysis. They go through the courses, they go through the videos. And like, I didn't know that. I mean, some of the most basic stuff. I had a gentleman years ago that had been through 8 workshops. 8. And I asked him, how do you define a trend? Define a trend for me in 4 words. He looked at me confused. Why 4 words? Because that's all it takes to define a trend. That's how you define a trend. He couldn't do it. Blew my mind. Blew my mind. 8 times he went through a workshop. It's a different company, but he didn't know the most fundamental, the most basic, simple, most important piece to technical analysis is how to define a trend. So now that's crazy. I know that's an old comment, Brenda, but I'm going to call it crazy. And then Weekly Whispers, we just launched this year, beginning of this year. So that's where every week I give you 20 to 30 candidates. We do kind of a macro picture, look at the overall picture, and I find a few squirrels here or there. Small account, big returns. That's one I did. It's a recorded class, so you can watch that anytime. It's an on-demand class. If you got a smaller chunk of change that you're working with, I just give you some different ways you can build that and grow it. So awesome. Thank you, Lee. Lee just put a link in there so you can get that. But here is the topic of the day. I'm going to get through this fairly quickly, so then we can spend as much time as possible on the charts and looking at what's going on with this market. A couple other things. There's always lots to talk about, and I never feel like there's enough time in an hour. So I'm going to try to stay on topic, and then we'll just wing it from there. How's that? But what is the toughest part of trading? It's keeping this straight, right? What's between your ears? Hands down. There is everything else. I mean, technical analysis, you can learn to analyze charts, you can learn strategies. All that stuff is fairly static. But mastering the mindset part is the most challenging part to overcome. So that begs the question, of course, how do we conquer it, right? And I think of it as, I mean, you can put all kinds of analogies to it, but if you're a carpenter, you're a builder, right? You slap on your tool belt in the morning, you have all these tools. Some of them you use once in a while, but your hammer, your saw, those are things that you use on a regular basis, right? The most basic fundamental pieces are the ones you use on a regular basis. The other ones are for the one-off situations, right? And these are the two tools that I use the most. This is like the hammer and the saw. They get the most use, hands down. Most everything else is just kind of sort of fluff, if you will. But we're going to focus on scaling today. And what exactly is scaling? Some of you might not be familiar with the term. You haven't heard it. You maybe know what it is context-wise, but it's entering or exiting a position in separate pieces. In other words, you get in a little bit here, you get out a little bit here, and it's a way to manage your emotions. I'll show you exactly what I mean. So, but the benefits of it are you get higher potential profit with less risk. So you're reducing your risk. Who doesn't like that, right? We'd like to have zero risk if we could with maximum profits. That'd be ideal, right? And that is, it's not impossible to achieve. I've done it a couple of times, but it is very difficult. The one way I did it last year, and I kind of have been tempted to try to get on the Russell, but I did the Russell popped for a couple of days. I did a bear call spread, and in the money bear call spread, got like a $3 credit. And then I threw a GTC order out there for a bull put spread for a $3 credit on a $5 spread. So I got a $3 credit up here. It dropped back a few days later. It hit the other side. So I had a $3 credit on this side. I've now got an iron condor with a $5 spread, and I've collected $6 worth of credit. I can't lose no matter what. I tried that several times last year. I hit it once. That was it. The rest of the times, it didn't work out. I ended up taking small losses on them. They weren't huge, but yeah, that was cool. That was a fun one when it finally worked out the way I had wanted it to. But it does take either really precise timing, or there has to be spectacularly huge moves back and forth, which with the volatility this market is starting to kick into, it's becoming more and more possible, I think. So just make sure you understand what you're doing if you do that. I'm not a huge spread trader, as most of you probably know, but when I saw that and I tried it a couple of times and then it hit that one time, and the beauty was I had, I think, a 10 or 20 or 30 point range that if it landed in the middle there, then they both expired worthless. And so now I've got a $6 credit. So I keep everything no matter what. I mean, no matter where it ended, I was going to make at least $1. But if it landed in the middle of the two strikes that I was short, I think it was a 20 or 30 point range, then you get maximum profit. You collect the whole $6,000. So that was exciting watching it into the close because I didn't carry it away what it did. But anyway, so higher profit with less risk. Reduce fear. How many of you experience fear when you're trading? I know, ask a stupid question, right? Does anybody want to eliminate fear? Well, stop trying. It ain't going to happen. I'm sorry. It's just never going to happen. You can get to a place, right? When you get in the car, right? If y'all think back to when you started driving, you're terrified, right? You're 10 and 2 and your teeth are chattering, you're white knuckling it, and you're scared, right? Because what if you make a mistake and you crash? Now you get in the car and it's like, I mean, you know, it's still a possibility and you have that fear there, but it's minor because you've got enough experience to know how to stay out of the way. But the fear's still there. The possibility of a crash is still there. So the key is not to eliminating. You're never going to eliminate your emotions. You're never going to eliminate fear. Anytime I hear somebody say, I'll teach you how to eliminate fear, get rid of emotion. Never going to happen. It's like saying live life without emotion. It's not going to happen. So the key is to reducing it. Okay. Less fear, smaller positions, tighter stop, less risk. It ultimately gives you emotional control. Let me show you how. We'll just put some numbers to it. And this is just purely straight numbers. So they're scaling out and scaling in. This is one that many of you have probably done. And this is relatively simple to do. Scaling in is a little more challenging, and it takes doing it several times before you realize how powerful it is. At least it was for me. I didn't see it. But scaling out is simple. So say you buy 10 contracts at $10, right? Your target's $15. The option moves up to 12. You sell half your position at $12. You collect 6,000. You had 10 in the trade, so you take that out. You got 6,000 back of the 10. You've only got $4,000 left on the table, which realistically means your cost basis on the amount that you have left based on your original investment is $8. So stocks trading at 12, or the options trade at $12. Your cost basis effectively is 8. You got a $4 cushion. So by taking out half your position, you have dramatically reduced your chances of taking a net loss on the position. So if you've ever done this, you know how good it feels to have a position, to bank profit on, say, half of it, and now you just sit and go, okay, I'm not worried about the other half. I've got a cushion there. I can leave a relatively loose stop. I can let this thing gyrate around, do its thing, and hopefully it'll go and hit the target. So you all of a sudden breathe this kind of, now I don't have to worry about it, right? Because if you're in the whole position, you still got the whole 10 grand on the line. Now you've got less. So you can relax, right? So we're going to look at the two different scenarios and the risk versus reward. So if you leave the whole position, right? From 12, the option drops to 8 before you get out. So news comes out, something moves quick, it goes against you. You've lost 2,000, right? Because you put 10 grand in, it went up to 12 grand. You didn't cash out. You left it all there. Now it dropped all the way back to 8, hit your stop. You lost $2,000. If your target's hit, you make 5 grand. So it runs from 10 to 15. You leave all 10 contracts there. You made the full $5,000 you were shooting for. You missed absolutely zero profit. Now, when you exit half the position, you went from 12, your option drops to 8, right? So you bought it at 10. It goes up to 12. You take half the position out. Your cost basis is 8 now. Now the stock moves just like it did before, and it stops you out at the other $8. So now instead of losing $2,000, you've lost zero. You haven't lost anything, even though the stock moved against you. If your target's hit, you got a $3,500 profit. You missed out on $1,500 by taking out half the position. Because it goes up to 12, you take out half, it continues to run to the 15, you left some profit on the table. Now, some of you are like, I don't want to do that. Of course you don't. Nobody does, but you're going to. It's going to happen. It's just reality. You have to get used to it. It's not easy. Okay, 23 years at this, and I still get cranky about it. Now let's talk a little bit about scaling in. This is one that is a little bit more challenging. Mainly because you look at something and you get into it, maybe you pick up a half a position, right? You pick up 5 instead of 10. And it's really hard to say, well, now it's $4. I just paid $3 for it yesterday. I should have just bought all 10. Well, shoulda is a phrase that you should learn to recognize. Woulda, shoulda, coulda syndrome, right? Oh, if I would have just gotten in, I could have made a bunch of money if I would have just gotten in. I should have just bought all of them. It's not a good syndrome. Okay, you've got to learn to manage it. That's one reason this is hard, right? Because you look at it, you go, well, I don't want to pay more for it than I did yesterday, whenever it was. But look at the numbers. This is where I think this is even more powerful than scaling out is. So we're just going to flip the script, use the same numbers, but this time you're going to buy 5 contracts at $10, right? So you put $5,000 initial into it. Your target's still 15, just like before. Your stop's still at 8. It moves up to 12, just like in the scaling out example, right? It moves up to 12. You buy 5 more contracts at $12. And that's the hurdle that's hard, because I just paid $5,000 the other day. Why would I pay $6,000 for another half? Well, now your cost basis, though, is at 11, right? It's actually added to your cost basis, which is the other mental part that people struggle with. I did too, so I understand. But the beauty here is that, well, you could do this obviously with the other one. You could move the stop up to 10 if it moves up to 12. So in this case, though, you move your stop up. In either case, you could do that, right? So you would take less of a loss. But your cost basis is 11, and the options trade at 12. So you still have a little bit of a cushion before you get to break even. But we move the stop up to 10, and you've just doubled the size of your position, and you still have that little bit of wiggle room there before you're in the red. So let's look at the numbers on it now. Do a comparison side by side again. Say you do all 10 contracts. Your initial risk is 2,000. Initial profit potential is 5,000. Right? Your final risk potential is 2,000 and your final profit potential is 2,000. That's pretty simple, right? Your risk reward is essentially 2.5 to 1, right? You've got 2.5 times upside as you do downside. But if you look at the scale inside, your initial risk is 1,000. Your initial profit potential, which is based on the idea that the stock gaps to your target, right? If it moves slowly, you're going to add to it, right? If it moves up to 12, you're going to add to it. So that only applies if it gaps from 10 to 15, say overnight, or it moves so fast that you can't get in, you can't add to it at 12. Your final risk potential, though, because we moved the stop up, is 1,000. Your final profit potential is 4,000. So you're leaving $1,000 on the table, but you're also cutting the risk in half. Your actual risk reward is 4 to 1 versus 2.5 to 1. So you've not only got a better risk reward ratio, but out of the gates, you cut your risk by 50%, and you're only giving up 20% of profit potential. So you cut your risk by half, and you only cut your profit potential by 20%. It's a good deal, right? And if you haven't experienced it, if you're trying to wrap your mind around it right now, then that's normal, okay? Don't think you're weird, because I did the same thing. It took me a while to finally start to see this. And then when I actually started to implement it, I went, holy cow, this is powerful. Because how many times have you gotten into a trade and it went against you almost immediately, and you wish you would have had a smaller position or not gotten at all, right? You wish, I wish I would have got, I should have got in there. Shouldn't. If I would have just stayed out, I could have saved all my money. What if you just got in with 1 or 2 or 3 contracts, 4 contracts instead of 10? Now your risk is dramatically reduced. So I utilize this in multiple ways. And obviously you could do whatever you want with it. You could do lots of different ways. I love to pick up just 1 or 2 contracts, small positions early, especially with, say, patterns, right? If you have a pattern that's developing and it hasn't broken out yet, and it looks like it's going to, then I like to nibble, if you will. Right? Any of you go to a strange pool or a strange body of water and just dive in head first without checking the temperature? No, right? You stick your toe in the water, right? I like to stick my toe in the water. Like, okay, is this cold or is it hot? Or what are we doing here? I don't want to just dive in and find out that I'm going to freeze or snap my neck, right? So, like, here's a pattern. It looks good. Let's stick our toe in the water and just do 1 or 2 contracts. And if it continues to move, then we'll add to it. So just to reiterate, here's the beauty, is that you get higher profit potential with less risk. So you're reducing your overall risk with higher profit potential. You're reducing your fear. You're managing your fear in a good way, right? Less fear due to smaller positions and tighter stop. Because have any of you experienced the that fun where you get into something and you put the stop too tight, it stops you out and ticks down a couple of pennies or maybe a little bit, small percentage, and then it turns around and does exactly what you expected it to? This is a solution. If you find yourself doing that a lot, because I know when I started, and a lot of people over the years that I've been coaching, like, well, I get stopped out and then it turns and moves. Your stop's too tight. How do you solve that? Because that's a problem, right? If you're getting stopped out all the time, you're putting your stop too tight. So cut your position size down and move your stop down lower. If you buy a stock at, say, $20 and your stop is $1 behind it, it's at 19, you keep getting stopped out. Yeah, you're doing, say, 1,000 shares, 10 contracts. Well, cut the position size down to 500 or 5 contracts, and then move the stop down to 18. You got the same risk. It's just you're less likely to get ticked out before it moves, if it moves. I mean, it could obviously keep going, but you see what I mean, right? The ultimate dollar amount is what you need to look at. And if you find yourself in that position getting stopped out, then lower your position size and loosen the stop up. So you have the same dollar risk, but you're going to give the stock that room to wiggle, right? Yeah, opposite of dollar cost averaging. Exactly. And see, people understand dollar cost averaging because the mainstream talks about it. Well, yeah, lower your cost basis. Then that way, when it bounces back, go ask the people in, what year was that? I don't remember. Go ask people that dollar cost average into Enron, how they like it. What are some other ones? What's the other one that blew up? I mean, dollar cost averaging can be effective in the right situation, but I'm not a huge fan of it. I think it depends. I do it occasionally if the situation is right and it makes sense, but typically that's on a mean reversion trade, not just a normal trade. But the beauty is dollar cost averaging, you're lowering your cost basis in a losing position. Here, and it is exactly opposite. We're raising our cost basis, but we're already in a winning position. And even though our cost basis may be going up, we still have a cushion there, right? If you bought the option at 10 and it's at 12 and you add to it, again, like the example, right? If it's half and half, your cost basis is 11 and it's sitting at 12 currently. So it still can back up a little bit before you go into a red position. But now you've got twice as much opportunity. So if it does run to the upside, now you've got even more there. And often what I'll do is you combine the scaling in and scaling out, right? You pick up one contract here, two contracts here, maybe 5 contracts here, and then you add to it here, and then you put an order up at 14 for 3 of them. So you buy 5 at 10, you buy 5 more at 12, you put an order at $14 for 3 of them. So okay, great. If it hits $14, you take 3 of them out. You leave 7 there. Okay, if it blasts through 15, great, I'm making more. Maybe you put an order out for 2 more at 15. So now you're down to your original 5, you bank profit on 5. And now if it blasts right through 15 and goes to 20, you're making even more, right? And that's the emotional management, is doing it piece by piece. You get in a little bit here, you add to it, then you peel some of it back, then you peel some of it back. And honestly, this is what hedge funds do. The big money managers, they don't buy 5 million shares at a time. They go in and buy it in chunks. And if it's rallying and it's trending, they'll continue to add to it. And add to it and add to it. That's what creates those long-term trends, right? When things are trending higher, when we're in a bull market, money's flowing in, you're making money, you're putting money in your 401k, all the money managers are getting it. And they got to put it to work. What trades are working out? Which ones are going in our favor? Keep adding to them. They just keep piling money into those trades and they keep going. They keep making more money, right? We just needed to take that same concept and apply it to our trading. You are very normal, Jennifer. Jennifer's just like, psychologically scaling is more difficult for my brain, but I like the idea. Start doing it. Do it on paper if you need to. Start doing it and watch how it affects your psychology, your emotions. Okay, let's jump to some charts. Where are we at? Where did our charting go? We'll close that. For example, here is this is on the list. You always lose. I just saw your comment, Les. I'm not sure what context that was in when you say you always lose. You can't always lose. You got to get lucky once in a while, right? But here's one. In fact, you know what? Let's just do this. I think. Do I have an order on it? I don't know if I have an order sitting out on it or not. I don't. Let's see. I don't. So I'm going to use this as a live example of doing this. I mean, this is not. This Omega charts. I'm assuming y'all have this. If you don't, I would suggest getting it. But so there's NVIDIA, right? Y'all see that? That it doesn't get much more beautiful than that. It really doesn't get any prettier than that head and shoulders. I can't. I mean, I'm just chomping at the bit waiting for this thing, right? And I'm about to. This is an example, especially when you have highly volatile stocks that have potential for giant moves, right? This is what, 70, almost 70 points of potential. Well, it's $84. It's $84 from the head to the neckline if you go off the close, right? So the only thing that worries me a little bit about this, the fact that it's been slowing down. You see the big drop, right? We got the huge, I can't remember when news came out. News came out the other day. Huge volume. The volume's been slowing down. So the bears are calming down a little bit, right? They were super excited this day and they continued, but they're a little less aggressive now, except today we're 3 hours. So we're about halfway through the market and we're at 21 mil. So yeah, we're going to hit the average, maybe a little bigger than average today, as long as the volume keeps on pace of what it's done so far. So 412 to 330 is basically 80 bucks or so, right? If we pick up a little piece right here, even though this is support right now, and I would normally say, don't ever get into a head and shoulders before it breaks the neckline. But in this case, this is where I like to nibble on this thing. So, well, let's see. So this is essentially, this account I use is mimicking a $100,000 options trading account. So my 10% rule says I can't put more than 10% in any trade. So it is, well, I think I've explained this to some people, but so this is the $1 million account, right? This is the weekly whispers account. It's $1 million, which is 10 times, because options, you get approximately a 10 to 1 leverage. So for every 1% the stock moves, your option moves about 10%. The options on this platform didn't trigger when I tried to put this together and make it work for tracking my trades, right, that I do in the weekly whispers. So I just did it with stock. But I had to set up something that would work that was relatively the same. So I set up $1 million account to mimic a $100,000 account. Hopefully that makes sense. And then it just trades stock based on how much. So $100,000 is what can be put into one trade, which is 10% of $1 million, right? So 10% of 100,000 would be 10,000. So same thing. Potato, potato. I know it seems confusing, but I finally got it straight in my head. So that means realistically, see, that's the challenging part about a $400 stock. 100 shares is 40,000. So we could realistically do about 250 shares on this. I'm just going to call it 200. I probably, and this is a little aggressive, but I would probably do, well, and with options, if you're looking at 10 contracts, I'd probably be picking up 1 or 2 right here. I'm going to just do this here I'm going to do 100. I just keep it in round lots to keep it simple. And I'm just going to plug it here at the market. And this one, I'm going to get a little, because of the beauty of the pattern, I'm going to be a little more aggressive than normal. Normally I'd only go 100,000, but we could really, so if we do 300 shares, it's 120,000. So it's 20% over, which I do sometimes, right? If the pattern is beautiful and everything looks great, sometimes you stretch the rule a little bit. So we'll go to 12% instead of 10, maxing out. So we just picked up, where to go here? So I just shorted, right? Same as buying puts. Shorted 100 shares, 412.67. That's what it got filled at. I'm up 20 bucks. Woo! Now look at this going, the entry, the risk reward entry, 3-to-1 risk reward entry, which is what the orange lines and the green lines are, right? So we got 68 bucks of potential. We got about 22 bucks of risk. Right now, though, I'm going to go in and put a buy stop because I sold it short. GTC at or above 421.66. So that stop out point right there, I'm going to hit submit, and then I'll go in. It'll sit over there on an order. So that'll sit over here. You can see here, buy 100 at 421.66 as a stop. It's working. So if this thing turns around and bounces, it's going to stop me out right there. So I shorted at 412, 421. What's that, 9 points? It's almost exactly 9 points, actually. It's a penny off 9 points, and actually it's $8.99. So I have $8 of risk versus 22 bucks of risk if I wait for it to get down here. Now, what I like to do in this situation is say, okay, here's what's that, 406. So I'm going to put another sell order. You would do this if you're doing options, you put a contingent order, stop at or below 40. I'll just put a 405. I'm going to use a round number. It's fine. So over here, it says the weekly whispers account, short 100, add to short. We'd be short a new position would be short 200. I always read this to make sure that I'm doing the right thing, right? Because you're doing everything over here. Always make it to GTC and then hit submit. And there's another order over here. So we've got the buy order, the stop out to get out if it goes against us. I've got an order to add to it here at 405. So if it continues to fall and breaks this blue line, gets down to 405 just below it, I'm going to add to it at 405, which will make my cost basis, $8, about 413. So my cost basis will be 413 when the stock's at 405. Then I'm going to go in here one more time, and I'm going to say GTC at or below 399. Well, when you read this, it says short, add short 200. That's because this other one hasn't triggered yet. So it still sees, the system still sees as 100. I'm adding 100 to it. But at or below 399. So I hit submit, and now that one's in there. So now with NVIDIA, okay, you can follow this and see what happens. This thing could, I mean, we are pretty oversold. It very well could bounce and take off to the upside. The bearishness has gotten pretty intense the last few days, and I think it's going to continue. But a short covering rally would not be surprised. So it could stop out. You know, we take a what, an $8 hit, $9 hit, $9 on $42,000 is not much at all. Percentage-wise, it's tiny. So by the time we get done, 399 for our cost basis would be about 407 or so, I think. My math's just eyeballing it. So your cost basis is at 407 instead of 399 when you get down to the 3-to-1 risk reward entry point, which means realistically, you know, from 421, that's 13 points of risk versus 22. So I've reduced, instead of waiting for it to get to 399 and jumping on all 300 shares, now I've got a little bit of risk right now, only about $9. If it continues to fall, I'll add to that risk, but I'll have a little bit of a cushion in place. So I'll still have less risk. And then I get to the 399. Now I've got the full 300 share position, 3 contract position, or 10, whatever the numbers are, right? Whatever you're doing. And I've got, what, a 7 or 8 point position? 7, 8, yeah, about 8 points, 9 points of cushion. Because I'm just getting in little pieces as it goes. And then if this thing just bleeds and it drops all the way to, you know, the 331 target. But here's the other thing I'll do too. See, okay, if it hits that, okay, we've got 100 shares right now. Go in and put a buy order in for 100 GTC at or below, limit order 375. So short 100, I'm going to exit from the short 100. But by the time it gets to 375, I've got 2 other orders that will trigger, which means I'll have a full position of, I'll have all 300 shares. And then I just hit submit, save it. Now I don't even have to babysit this thing. If the other 2 come and trigger, I have to adjust the stop. That's all I have to do. Now, if it falls and I get out at 375, I've got one position that I got in at 412. So that 100 shares I got in at 412, now getting out at 375 is, what's that, 25, $37 of profit? Whereas if I waited for the 399 entry and got in, went whole hog here, instead of scaling in, I'm only $24 of profit. We're here, I've got 37 on this other 100. And then if it keeps going, well, there's the beauty. If it gets to 375 and hits that, I've got $37 of profit, only 200 shares left. My cost basis was 407. Take about 17. So my cost basis is about 390. If my math's working right. You have to run the numbers. I'm just doing it in my head. I think the coffee's helping. But yeah, my cost basis then is about 390, which is on the other, I still have 200 shares. It's about 390 right here. It's at 375. I got $15 a cushion now, which, I mean, on a $400 stock in NVIDIA, $15 is not huge, right? But you can see how you can now relax and just kind of chill out. You could even put your stop back up here at, you know, above 400, say 405, and you get hit for $15. If your cost base is 390, 405, that's $15 on two contracts, 200 shares. That's $3,000. You already banked 3,700 on 100 shares. You leave your stop back here at 405, you get hit, you're still making $700. You still got a profit. Good, Jennifer. That was I'm glad that's helping. So, but yeah, and that's the whole point, because now again, I can just relax and chill out. I'm sitting on this trade and I don't really have to do anything at this point. I have to keep an eye on it, and holy cow, kitty, stay out of my water. That scared the heck out of me. At least she didn't land on my back. She's done that before. Didn't feel good. She got sharp claws, and she's getting big now. So Leave her alone. She's coming down to help me. She's just sitting over here on the side of the desk. Anyway, hey, if she stabs me in the back with her sharp claws, because she's done that, she slipped and fell off there and literally landed on my back. She's done it twice, and it hurt. So, actually, I think I was doing one of these one time, wasn't I? When she did it. Anyway, she likes to come and steal my water. She's got her own fresh water out there, so yeah. Does that all make sense? Any questions on that? And I'm glad that's helping, Jennifer. I think I said that already, but yeah, I mean, I don't even have to babysit this that much. I can just let it be. And if it gets down to 405, then I know it's triggered another 100 shares. And realistically, I could even pull the stop down from there if I wanted to. Adjust the stop down to, wherever makes me more comfortable. But you've got to make sure you're leaving enough room to wiggle around and dance around and do its thing. Because some of these stocks, especially the volatile ones, are going to swing a lot. And that is, again, that's the beauty of doing it the way, like I just showed you, is there's 100 shares here. I got $9 at risk is all, which isn't a lot, relatively speaking. If it backs up and hits my stop, okay, I swung the bat. And you know what? I missed the ball. Cost me a little bit. Now we step up to the plate again. If it rolls back over, cracks the neckline, next time I might wait and see. So I think you can do, I would just leave it here where it is. We got 100 shares. It'll get 100 here, 100 here. If it hits this, then I'll adapt and shift it there. So good. Should we do, what's time we got? About 15, 20 minutes. Let's see if we can do this. And this is the one thing, and I just figured this out actually this morning. I was trying to figure out if there's a way to use this. Okay, some of you have seen this replay history thing. And which basically allows you to go back, and you got a bunch of different things you can do. You have to go play with it. If you've got Omega charts, you can use this. And we can basically go back and do our charting. We're back in 2012 here. We can go draw our lines. We can do whatever we want on here, do all our analysis. And then we can, just like the little practice trading system you saw me using there, it's in here too. The only thing, the only challenge to this is that there's not actually a way to scale. And that's what I've been, and it just, I don't know why this morning it hit me. I'm like, oh, we can do this. Duh. I don't know why I didn't think of that before, but I'm not even sure what stock this is. I don't care. I don't know what it is. I had it randomly picked from the S&P 500. So some stock that's in the S&P 500, been around since the 90s, maybe longer, late 70s. So it's an older stock. But you see we're in a pretty solid uptrend. So this allows us to move forward one day at a time. I'm just going to have this go quickly. Oh, hello. I'm getting close to breaking out. So now I'm going to look at this. Say, okay, if it breaks out, we have kind of the beginnings of a flag pattern there. So if it breaks out, I want to get long this thing. Question is, how far might it go? And I'm going to do some quick analysis. This isn't really an ascending triangle, but it kind of is. You could stretch it and call it that, but speed analysis, like speed dating, right? Just got to hurry up, make a decision. So we'll call that our target. There's our, oops. Yeah, well, right there's good. Just scrunch it down all the time, but stretch that just a little bit higher up to call it right there. There we go. Oh, look at that. We should have exactly $1. 3 to 1 exactly. That was accidental. So we popped up the upside and we're pushing that resistance. If we break above there, this is an all-time high, which typically it will continue to run, right? So what to do, how to trade it. So I'm going to do the same thing we did on NVIDIA, except I'm just going to say pick up 100 shares just right here at the market. It's sitting right there on the edge. It's kind of sort of broken out, but it hasn't. stop loss. I'm just going to leave it there and I can drag it around. So that's the beauty of this is you can take this, get your finger on it. You can drag it wherever you want. So I'm going to put the stop right here, just 100 shares, right? Which would be what, $4,600. If you're doing option contracts, it's just essentially 10, or I mean, one contract. So you just have to adjust that in your mind mentally. So now if this thing backs up, okay, it's going to cost me, what's our entry point? What did it close? 46.80. It cost me 46 cents. So now we'll just move ahead one day at a time and see what happens. Actually, you know what? Shoot. See, this is the hard part, is that there's no way to put, like with NVIDIA, we can do multiple different trades. And if it hits, it hits it. You can't do that here. Once you're in a position, you're in a position. You can either exit it or reverse it. Those are your only two options. So what I figured out just this morning when I was playing with this, trying to figure out if there's a way to do this is, okay, if it hits that 47.34 entry point, then I go sell 100 and turn it into 200 or whatever number, right? You're going to add to it. So you got 100 shares here. We're going to make it, if it breaks above 47.34, let's say we're going to add 3 times. We're going to add 200 more shares. So we have a position of 300 shares. Whatever numbers you want to do, you can do it. So then I just sell it 100 and then immediately buy it back at the market with 300. So you're tripling the position with basically a wash sale, if you will. So let's see what happens. Oh, there it went. There it hit right there. Okay, so I'm going to hit exit. So we're up $65 on 100 shares. We're going to hit exit. And then I'm going to go buy 300 at the exact same price. So now we've tripled our position size. I'm going to leave the stop at the original spot. So I have 3 times as much risk. But we'll see how it goes. And then we'll move that stop accordingly. And if it hits, let's say we'll take 100 shares out if it hits, what's that, 49? So if it goes up to 49, gets about halfway to the target, we'll take out 100 and leave the other 200 there and pull the stop up. Okay, that's not good. Okay, that's okay. Because we've got this resistance level here. As long as it holds that level, we're all right. Uh-oh. Get nervous? That's what I love about this. You can go back. I mean, we're all the way back in the beginning of 2013. This is 10 years ago. And who knows what's going to happen with it. Okay, looking good. Ooh, do we want to add to it? Look at the volume. We just had a little volume pop in it. Should we add more to it? Because we just it held this line. You know what? Let's add 100 shares to it. So I'm going to hit exit. I'm going to buy it again and go 400. This might be foolish. It might not. Guess we'll find out. Welcome to trading, right? You always got to be willing to put a little risk on the table. But with the movement it just made and the increased volume and the increased upside, I'm willing to put a little more risk out there. Come on. And now actually, if it gets to, what's this, about 48.50? If it gets to 48.50, I'll peel out 100. If it gets to 49.50, I'll peel out 100. Uh-oh. I get nervous. I don't know what's coming with this. Okay, that's good. Did it hit 48.50 yet? Nope. Still just dancing. Oh, it's getting gross. There's 48.02. Should we pull some? You could. I mean, if you're getting nervous, and this is the beauty of scaling, is because you can look at this and say, you know what? I'm up a bunch. I'm not quite to the 48.50, but it's making me nervous. I don't want to give back my profit. Let me peel out 100 shares or 200 shares, whatever number it takes to get you comfortable. The ultimate goal in trading is to be in a position where you're not nervous and freaking out, and you're managing your risk in a way that you go, okay, if it hits my stop, it's okay. I'm comfortable giving that amount of money to the market. If I give the market $300 to find out if I can make 1,000, I'm good with that. That's a fair deal. Because realistically, if you do that 4 times and one of them hits and 3 of them you lose 300, make 1,000, you're still up $100. Be your risk reward. Then scaling. Now you wish you would have taken it out, right? Oh no. And there's exactly why, right? I should have taken part of it out yesterday. I would have preserved some profit. And actually, the volume increase definitely has me a little skittish. So, you know what I'm going to do? I'm going to cut this position in half. So we're going to exit and then go back and buy, make it just 200. So we were down negative $58. Now we're down $38. If it stays above the support, actually, why did that move down a little bit? Move that back up to the actual stop. I guess that's close enough, but. So yeah, the increase in volume definitely says, okay, maybe this thing's not going to take off. So I cut my position in half and see what happens. And now you're kicking yourself for not hanging on, right? But you know what? Had a net profit of negative 38. Right now, the open is 266. And the volume just came back in with a vengeance. So do I wish I would have held on? Of course. But you've got to go based on what you see, right? You've got to go off of what today. And yesterday, it looked like it was turning bearish because you got an increase in volume, a big drop. But there's the beauty. I'm still in it. So now, actually, you know what I'm going to do? I'm going to take this stop and say after that move, I'm going to move the stop up to basically break even. Close enough, 36. Now, if this thing pulls another thing like it did yesterday, it drops off, I wouldn't be very confident in the bullish move anyway, so it'll get me out of break even. All right, a little nervous. Ooh, what's the low of that day? It's going to be 35. 37. 47.37 is the low. It stops at 47.36. Missed it by a penny. It might hit tomorrow. Who knows? Nope. Do we just take it, get out, or wait? The volume's getting light. Kind of tempting to pull it back. Let's see what happens. This is where it gets irritating. It just goes sideways. Oh, there's 47.50. Are we still taking half out? That's the open, right? You know, I'm going to take half out right there because I don't know what this thing's doing and it's getting goofy on me. So we're going to hit exit. That takes the whole thing. Buy 100, so it cuts the position in half. I just realized I could do this morning. So it's kind of cool. Actually, I've never been able to do this where you can kind of sort of scale without really scaling. So we're still in at 100 shares. Let's see what happens. I don't know why it does that. It's going to take off a rally now big time. If we would have left the 400 alone, we'd make a killing. Oh, there it stopped out. But you kind of get the gist, right? It's where you just, if you find a pattern, you find an opportunity to trade something, you can get into it and add to it if it's moving the right way, and then peel it back. You don't have to go all in and all out at the same time. You can do all kinds of jockeying like this. And here's the other beautiful thing that I love about this. You hit reports, and you can get all kinds of data, right? We had a total of 5 trades. Total profit was 138 bucks. Average trade, you can peel through a lot of this. Return percentage, oh, that's return. Winning percentage was 40%. 40%, and still profitable. This is why 3-to-1 is so important, right? You'd be doing about 41 trades a year. But here's what I like to do that I think's Kitty, she literally just sat on my hand, trying to run the mouse here. It's a good way to put it, Jennifer. Suspense, strategy, and learning. Best video game ever. Hey, gosh, she's grabbing the mouse. Get off. Sorry, Brenda. I had to push her off. She's literally biting the mouse cord. Usually I love her, but it's times like right now she's annoying. So here's the Monte Carlo analysis. This is one of those things, and it's there's a mathematical algorithm behind this. But you can go and say, what's my annual profit drawdown based on the trades? What it does is it takes your average, the trades that you've done, and it says here's the averages, and it runs 20,000 simulations and tells you what you do on an annual basis. So you hit run and it goes through and crunches all the numbers. Your average annual profit is $1,165 with a drawdown of 489. So your average win was $164. Average loss is 64. Expected rate of return 43.58%. So if you just take what we just did and continue to do that throughout a year, just that little blip of trading we did, you're going to get about 40 to 50% a year rate of return. That's one reason I absolutely love this system. You can go back and do it, and you can save it too. If you want to do games, you can save them. Yeah, 50% is, if you do 50% a year, you're doing well. If you're trading aggressively like this, right? Good year is 100 to 200%. Spectacular is like 300%, which is extremely difficult to do. So it could be done, and it's been done, but it's not easy. You got to have a handful of really monstrous winners. And like I say, it happens, but it's got to be certain market conditions. You know, years like this year, almost every trader that I know is struggling this year. They're not doing that well. I'm not doing that spectacular. Last year was spectacular. So, but the market was trending, right? When the market's not really trending and it's just kind of sporadic and it's can't seem to make up its mind, then it's a lot more challenging. It's always challenging, but when things are trending and they're moving one direction, everything's going one direction, it's significantly easier. Right? The market's much more forgiving. You can make a stupid mistake, and if you hang on to something too long, then you still come out okay. If it's choppy and sideways, that doesn't work out so well. But all right, we got about 9 or 10 minutes left. There's the cues. That was Brenda, right? Yeah. Well, there it is today. It's down. No surprise. We got the head and shoulders. That it's finally coming back into play. We go right. And the other thing with the cues is you've got, because this is NASDAQ is all it is, that downtrend line we just tagged the other day. So it is it's looking bearish. Everything's looking bearish. The NASDAQ not so much, but spiders. Excuse me. So there's your beautiful head and shoulders. So it is the market's looking very bearish. I know some of you have probably seen see if I have it in here. I think I do. I was looking for this yesterday, actually. Where did I put it? You'll see the 08 comparison I did. I don't know why I can't find it. It's really kind of irritating. Maybe I put it in here. Because, yeah, I wanted to. No, it's not there. I don't know where it went. It's really frustrating. I thought I know I've pulled it up before. I just don't know where it went. But you know what? Maybe it'd be. That's not it. Really kind of irritating. I don't want to hunt for this forever. I really want to show you, but let me just show you. You can go back and look, especially if you have this. I know. Somebody start playing the Jeopardy tune. You'll have to go do it on your own. I can't find it, so I can't show it to you. But there is, and actually, I already deleted this on the Russell, but there's a head and shoulders on the Russell. Go back to January of 2008, mid to late January, February of 2008, and look at charts like this. If you have it laid out as four, you can look at them individually. What you will see is that all four major markets are in a head and shoulders pattern: the SPX, the Dow, NASDAQ, and the Russell. In fact, I wonder if I think I can probably do this really quickly if I can. 2008. Close enough. See if I still have it drawn there. I don't. I guess this is 2007. Yeah, it was. Okay, there's January of 08. You'll see it. There's the Dow. I think I can do this quickly. Get them all the same. That's 11 of 08. There's the SPX. I'm going to, well, see how we can do this real quick. Come on. That one's right there. It's not a little bit. Yeah, it's a little bit obvious, but one more. I got a few minutes. That's all right. We can make it. That was not as, the Russell's not quite as pretty, but it's pretty close. It's close enough. So this is, I mean, there's, let's just say, what line is that? 220. We'll get them close. Close. So I'm dropping these vertical lines all about the same date, right around February 20th. So this was back in 08, right? You look at that blue line, head and shoulders, head and shoulders, head and shoulders. That one's not quite as pretty. Head and shoulders, and you see all what happened. That's 08. This is, if you're wondering why I'm bearish, especially, and right now I have been more bearish than I have been since the end of, since, yeah, 2021, basically. And that's why right there. Because we have the same pattern. If we go back, I don't know if I can reset this without. Oops. No, don't save. I wonder if it'll go back or not, if it's going to stay back to the. Okay, good. It brought it. So this is back to normal now. That worked. So there's current. Doesn't look much different, does it? The head and shoulders are there, and they're about as textbook as they get. And they've been below it for several weeks now. I mean, we broke it. Not only broke it, we rallied back up, got close to it. The NASDAQ actually broke back above the neckline, but it did find the downtrend line and has dropped from there. And now it's below, and we're about to breach the lows here today. Russell already broke down big time yesterday, closed on new lows. This is the banks, right? The small companies. The small companies make up a large percentage of the economy, and they're getting beat down. So the Russell, I see the Russell hitting 1,000 or so, possibly in the next few months or a year. So, and I think the rest of the markets are headed that way too. So if you're not playing the bearish side, I would consider flipping over, because the overall picture is just not looking good for the economy. So there's just so many little storms brewing, but I've gone down that road many times. So, but yeah, the spiders, it looks the same as the SPX, because it is the SPX, right? And it came up and we basically closed that window. We stalled out here for several days. This is one thing I talked about in the weekly whispers a few days ago. It's like, if it can't break above that level, it's probably headed down, and it's been trying for several days to hit it. And I think it was just Tuesday on the update that I did. I said, if this thing breaks down tomorrow, we're probably headed lower. And we've been doing that for 3 days. So I mean, things can always turn in reverse, and they're starting to intraday, but it's looking pretty sketchy. So, but, and that's the beauty of getting back to the theme of today, is scaling. It allows you to just relax, right? So try it, implement it in your trading, start doing it a little bit here, a little bit there. Paper trade it. If you have this, go back and use the Omega charts thing, and do that. And it's one thing, if you're in weekly whispers, you know, I talk about it often. I mean, I just talk about what I'm trading and what I'm doing. So yeah, it's a spectacularly amazing tool. So I suggest everybody use it. You add that with the risk reward and scaling, you do both of those, and you'll be at a place where you're just calm, cool, and collected. It took me a long time, but I finally got to that place where now it's like, I don't trade without emotion, but I very rarely get amped up and excited and start to freak out and get nervous. Most of the time, I'm just super calm, cool, collected, just chill about everything, because it's all set up, just like the NVIDIA trade, right? We got just sitting there. Did it stop us out yet? Nope, it's still there. We're upside down a little bit, but it might stop us out, but who cares? I mean, it's $900. Only up like 36 grand, 136 grand in this $100,000 account this year. So let's do okay. And if this market bleeds, I'm heavily loaded up on the short side. So if this market continues to fall like it has been, then that number is going to go up to 200,000 profit in a hurry, probably in 3 or 4 days. That's what last month was. And this is just so you have an idea. And I'm going to shut up after this. I'll show you. This is one of the things I love about this is the reports, right? Total net profit at this point that's already cashed out is 122, 582 trades this year. Winning percentage says 57. That's not actually, that's probably closer to 40. Because when you scale out in this system, if you buy, say, 500 shares and you take out 200, then 200, then 300, and they're all winners, that posts 3 wins. So the winning percentage is actually skewed because I do that a lot, right? I'll scale out piece by piece. But sometimes I scale in, you get a little bit in, a little bit in, but I'll scale out a lot more than I scale in. So it's probably 40 or 45%. Average monthly profit, 12 grand, right? And you can do the Monte Carlo analysis on this, go annual profit, see what this shows. And we've got, 10 months, we're 10 and a half months in. So it's not going to be much different than what's there. But and again, this is designed to mimic a $100,000 options account. Profit 144 on a $100,000 options account. Or if you trade $1 million stock account, you'd have that exact number. But I trade directionally, right? I buy calls, I buy puts. I do a few spreads here and there. But this is the monthly list. And you can see, I mean, there's profit. You got one, profitable January, February I lost a little bit. March was good. April I lost. May was a really good month. June was a really bad month. July was a bad month. August was fairly good. September, there's 2/3 of the profits for the year are right there in 1 month, which is pretty typical. You kind of go back and forth, right? You step up the plate, you swing, you get a base hit here, a base hit there, you get a double, you get a base hit, then you walk, and you strike out, then you walk, and then you get a triple, and then you get a grand slam. So this month so far is 18 grand. We'll see how it goes. I mean, if this market takes off to the upside, this is going to be bloody and ugly because I'm heavily weighted to the downside. So when you do that, you got to understand that you're taking a lot of risk. A lot of people don't. I do. I've been doing this 23 years. So I understand what I'm up against. And I understand that if it starts to go against me, I know how to react properly. So you got to make sure you're trading at your skill level where you're at mentally and emotionally. So anyway, all righty, we're going to call it a day. So appreciate y'all coming and hanging out. If you have any questions, you know how to get a hold of me. Right? If you're not into Weekly Whispers, jump in there, or Patterns in a Flash, anything really. So, and we will see hopefully some of you at Trading You tomorrow afternoon, whatever time zone you're on. So, all right, y'all have a great day. You have a great weekend too. Thanks, Alan. Appreciate it. Take care. God bless. Bye-bye.